I'm Peter Reznicek from ShadowTrader.net, and this is the Weekend Edition. As you know, this show is recorded in Los Angeles, California, so before we begin, obviously, I'd like to touch upon the events that have happened recently, especially by thanking people out there in our group, subscribers, etc., people who follow my stuff. Many of you have emailed me wondering if I'm okay. I haven't even had a chance to answer all the emails because there were a good number of them, and I just wanted to tell you how much I appreciate that. I myself and my family are safe, and we were certainly luckier than a lot of the people in our area, many of whom have been displaced. So our thoughts are certainly with those people here in Southern California. I haven't seen you in a couple of weeks now, so we definitely have a lot to talk about on this program. A lot has certainly happened from a technical basis. Today being Friday the 10th, we had a very large move up in the 10-year, which I think is what's kind of causing prices to move down a bit. But the move thus far has not been overly bearish. There's still been some rotational aspect to it, so we're going to kind of get into that, technical charts and everything else when we show what's really going on. Without further ado, let's get into it. On now to the technical portion of our program, where we always like to start it off. Of course, the most important segment called What's Really Going On, because as you know, I think it's all about the technicals. There's always going to be catalysts that push the market that people think are the drivers of the move. But remember, it's always the inventory position of the players and how the charts are setting up coming into that news that really makes it all happen. So let's shift over here, check out the S&P daily. I'm going to just put on this drawing tool here and just show you a couple of key things that I'm looking at for the week ahead. So firstly, we're in a channel basically, and I did draw a relatively large channel here coming up off these highs. Downtrend is still, is in effect here. So obviously we are making lower highs. If we weren't making lower highs, then we wouldn't have a downtrend. But we also can connect some lows here and create a channel. And that's noteworthy because this tells us that we're coming down in a more jerky manner. When you're creating a channel, you're kind of going back and forth like this instead of straight down, and that's important to note. My focus today on Friday the 10th, as it was here on this swing low here in the cash market, which was a double bottom. You see that's 58.29.53 at the end of the chart. This is really noteworthy to me in the fact that today's action moved down pretty aggressively, kind of in a two-sided manner, because if you were watching closely, you had a gap down, gap fill, and then close back down towards the low end of the range. And right at that level. And what I mean specifically about why I find this interesting is that the early action in the market today was probably a little bit too short to go lower. That happens a lot on gaps. That's really the reason why gaps fill, because at the moment, even if the market wants to go lower on whatever catalyst caused the gap down, the market is too short to go lower at that time. And that's what happened early today. So it actually rallied back and came back in. But it is still surprising that on the test early in the session, you can see this was kind of earlier in the session when you went lower, you weren't able to hold a move below what was essentially a double bottom. So that tells us that the key reference here at roughly that 58.30 level is the same going into next week. You can continue to look at this reference, and now you've got three kind of tests of it. And we'll see if we get lower, and I'd kind of be looking at the low end of the channel now, kind of shifting my focus down into this area. Now, if I could leave you with just one thing in this particular show vis-a-vis these technicals that I want you to take away from my presentation here, it is the fact that it is very common in the markets for acceleration to happen after kind of a choppy start. I am a big believer, through watching markets for so many years now, that tops are often very complex, but bottoms not so much so. So a top in the market can look exactly like this, what we're seeing here, and the acceleration happens later. My mentor in the market profile, Jim Dalton, always says the wagon wheel runs fastest at the bottom of the hill. So just think about that. So this is what could be happening. This is something that is hard to predict. It's hard to get short ahead of because of this kind of choppy action here. It tends to stop you out. But just remember that that could easily happen, and that is a potential scenario going forward, even though we're not seeing that much of a technical decline as of yet. So just keep that in mind as you go forward on the S&P daily. Okay, moving over to the NASDAQ 100 side of things. As always, slightly disconnected. We've been talking for a long time that this is what makes the market slightly more difficult when they're out of sync. We saw relative strength in the NASDAQ at the end of 2024, and that's also what's making this chart look slightly different, where the same channel that I drew down in the S&P, notice how much further away you are here in the NASDAQ 100. And also, we just talked about low here. This low is actually lower, and now you have the lower low here on Friday. However, where did we close? Right here, you know, it's similar to the other, right? It's kind of the same triple bottom, but at the same time with a bigger distance here to come down to the channel. So my sort of look forward on the NASDAQ 100 is the same as the S&P. Obviously, they move together, some stronger, sometimes weaker than the other, but the fact that acceleration could happen, we just don't know because the wagon wheel tends to run fastest at the bottom of the hill, and we'll see if we get some sort of a catalyst in January going to February that'll cause this acceleration. But for now, this is the technical picture you need to be looking at, basically, that you've got some distance here down to the lower end of the channel, and whatever decline you've been having, just like the S&P, has still been happening in a relatively halting manner. Okay, on to our lead story today, which according to the title of this video is how to defend short puts. And before I get into this, I want to give you a little bit of a caveat or disclaimer if I could. I gave a lot of thought to this because this can get very, very complicated. The example that I'm going to use is an NDX trade where we were caught short on the put side with some short verticals that were relatively large, that were in danger of turning into a very, very large loss. And I had to do a couple of key adjustments to get that into a much, much smaller loss. However, I'm not going to get too deep into sort of in the weeds on what the actual adjustments were. What I really want to do is stick to more of a surface level and talk about just one strategy that I think you can use that will help you if you need to defend short options. I'm giving you an example on the put side, but this also works just as well on the call side. Let's advance to this slide right here if we could. This is a snapshot of the blotter of my weekly options room. As you know, I keep track of every single transaction that I do there from start to finish, wherever the trade opens, every single adjustment all the way down to the close. And the trade in question here is 1747, which is an NDX play. And you can see here the loss was $884. And that's a decent sized loss for us. This advisory generally trades size of options, only 1 contract, 2 contracts, 4 contracts, 6, up to a bit max size of 8, but very rarely those size. The average trade in this advisory is usually 2 to 4 contracts. So we're looking at winners of anywhere from $100 to $600 or $700. And this loss obviously of 884 is a decent sized loss. But I wanted to specifically highlight this trade because this loss had potential to be much, much larger. And it's because I employed this technique that I'm about to show you, I was able to get that loss down a bit much smaller. Let's move over to the next slide here if we could. And I just want to show you this NDX chart for a moment. I've purposely circled a couple of areas that are noteworthy here because I want to just try to set the stage on what exactly got us in trouble on this particular trade. See this blue line right here? I apologize. I was going to write the word entry here. That's a mistake on my part. But I just wanted to highlight this bar last week where the NDX was very, very strong. And you can see that you've got the downtrend line here. We looked at it on the other chart in the what's really going on segment. And my initial play was a broken wing butterfly to the upside, right? So that's essentially a situation where you're long one option, short two, you are long another option above it, but that other option above it is quite far away so that you're able to then bring in a small credit or give yourself long exposure on the upside by not laying out any debit. However, you do have upside risk. And what happened in this trade was actually a big surprise to me. And I always kind of talk about this a little bit whenever we have this type of losing trade, is that generally when I get in trouble in weekly options, it's usually when the market does something completely unexpected or goes much, much further on a gap than it makes sense to me. And this was one of those situations. So if you can imagine, we are short here at the downtrend line. And look at this candle right here. You literally gapped up right to where we were at the midpoint. So that's why in the previous slide, when I showed you all those trades, you can see that there were a lot more entries to this trade than normally because I chased my tail a little bit in doing the adjustments. And as you know, if you're chasing your tail a little bit, adjusting short options or sort of, morphing your position, say, okay, now I'm short on the call side. I want to bring in some credit on the put side to finance what I'm buying back on the call side. Oh, then the market comes back down. Now you've got to do it in the other direction. Those of you with some experience in this game, you know that this can get relatively dicey and it can spin out of control very relatively quickly as you're chasing your tail. So that's basically what happened to me right here, where on this large gap up, I was forced to defend the short calls, using premium that I brought in on the put side in the short puts, not realizing or not knowing it at the time that the next day was going to be this red candle, which obviously put the puts into danger. And why was I even thinking that I should finance any call activity with short puts? Simply because, as you can see, the NASDAQ 100 broke trend. So to me, it was on, right? It was on to the upside. We literally closed here, gapped up here, and started pushing hard above trend. That made perfect sense to me. And then I looked at the chart, because everything I do is from a technical base, and I said, okay, if I need to defend these calls, where am I going to put credit to do so? To me, it was at the bottom of the gap, right? It made sense to me to put it at the bottom of the gap right here, because the 821, the blue lines were intertwined right there. And I thought, okay, if we've actually gapped up and broken trend, the odds don't favor that we would come back down below trend and fill the gap completely and come down below the 821. But as you can see, I was dead wrong on both counts, right? It actually did that. It broke all the way down through. And what that did then is it left us in a short put position that needed to be defended. And that's what I want to talk about specifically in this video, is the strategy to use to defend that, because there's a number of different ways that it could go. So if you look at this slide right here, where I show you the ideas here of what could happen. Let's say you have short options out there. They could be naked, they could be verticals. In this case of our trade, which I'll show you in the next slide in a moment, it was short verticals. But what can you do? You can, A, buy them back. That's usually one of the best strategies, but only if it's done early. Understand that my situation on the call side, I gapped up and went to it. So it's like everything was fine at the prior day's close, and then bam, you're there the next morning. So sometimes you can do that, sometimes not. It all depends what type of a loss you're willing to take right off the bat. Myself, I always like to do battle, basically. I always like to figure out what I can do to mitigate that loss rather than just take it, because I use options to their fullest potential, and I believe that they are called options for a reason, because you have lots of options, pun intended, right? So you could buy them back. Number two, you can roll down and out. Obviously, we're talking about on the put side. What does that mean? Buy back your shorts in the expiry that you are short and sell new shorts in a further out expiry lower on the put side. This can work. I don't like to do it because it essentially just kind of oftentimes delays the inevitable. And also, it matters a lot where and when you do this. You must be very, very careful and diligent to know what type of premium are you buying back and what type of premium are you selling. For instance, I often get asked the question by people who have not bought it back, who have not made adjustments, maybe they're not as seasoned in the game, and they're just kind of playing the hope card, and their options are now in the money. This has happened like 10,000 times where I've gotten this same email and they say, what can I do? And I always say nothing, actually, because in that sense, you cannot roll, because you are buying back huge intrinsic value and selling very cheap extrinsic value, right? So it's going to be a huge debit to roll it. So what's the point? If you're fully in the money, you might as well just go back to step one and buy them back. So it really matters kind of where you are to do number two. Number three is buy something below. That means that, let's say you were short a naked put, let's just call it XYZ at 100, you could buy a 90, which then instead of having almost unlimited risk, now you've got $10 of risk, or the difference between $10 and 90. Not bad, could be all right. And then 4, of course, is the famous do nothing card. This is the smoking hopium card. Basically, you do nothing and you try to wait it out, and you say, okay, I have a chance that it could be this loss, but it also could be nothing. If it doesn't quote unquote go there, I may be okay, and I keep the premium received. This one right here is not one I recommend, okay? This one is really never good. This is the one that will lead to blowing up your account. And this is the email that I have gotten way too many times from subscribers that said, hey, thank you so much for everything, Peter, but I have to quit the advisory, and I just wanted to tell you that it's not you, it's me. My account went to zero. And I really hate getting those emails. Obviously, I lose a subscriber, which is not good, but I really feel bad for the people that put themselves in that position, but it does happen. So do nothing is definitely not one that you want to go with. So what then is the secret sauce, or what is the, thing that I would rather do instead? And that is to spend extra money and buy something above. Here I said buy something below. I would rather pay more and buy something above, right? Because what does that do? That then puts you in a situation that if the market goes there, quote unquote, right, and in this case we're talking about a short put position, you can actually make money to mitigate your loss, and it might actually turn into a profit. And that's how, if you recall in the slide that I showed you earlier where I was saying, look, this could have been a really, really large loss, turned out only to be an $800 loss, we actually had over a $6,000 debit coming into the day before the trade expired. And as you can see, I showed you that I morphed it into an $800 loss only, which was much, much better. So let's move over to this slide right here. And this will just kind of show you again, as I said when I started this segment, I don't want to get too deep into all of the adjustments. This is just one portion of the trade, but it'll give you an idea specifically of what was going on the put side and what my max losses and profits could have been. Again, in a very simplified manner, although this is legitimately exactly what happened on the put side. It just doesn't show you all of the adjustments leading up to it. But I left myself on the put side before that NDX came down so hot and heavy. 6 units short at 21,300 with 6 units long at 21,250. Obviously, my max risk there is 30K because it's $600 times 50. So not a good place to be when I thought the market had a chance to move down. The next thing I did here was tightened it up, where I bought back the 300s and sold the 275. So you can see now my risk is only 25. As you can see here, 15K instead of 30K. But here's where things get interesting. And this one right here is actually what I wanted to show you as this turns into this, that this is the specific strategy that I like to employ in order to defend short puts, right? As per the title of this video. And that is to buy something above that turns the spread into negative delta so that you can make money. So you can see, like, coming into here, right? I add this on top. If you just do the math going forward, what do I end up with? This structure, which I call a reverse mullet, right? It's not a BWB, it's a reverse mullet, because now the top part is fatter than the bottom part. And I purposely put this little bracket here to show you there's 35 points to be made here, and there's 25 points short here. So obviously the net is 10, and I put here 6K to 21K. Why? Because if this crashed all the way through, I make 6K. What did I tell you my loss was before? I said my debit was about 6K, right? So I break even, or I could make as much as 21K because I've got 6 contracts here long times 35. That's your 21,000 right there. If you were watching closely on this particular day when we had the large move down the NDX, you'll know that we went down through all the strikes. These 6 units that I had of this structure had a maximum value of $10. I let the last unit expire and get settled to cash for the full $10 value. But before that, I sold for $7.50, $8.50, $9, $10. I did get one off at 11, but unfortunately, because there was so much extrinsic value in that middle strike, I couldn't get anywhere near this max value of 35. So I was really hoping, or I was just working the trade as best I could to try to get that, to get that $6,000. And again, long story short, turning what could have been a really devastating large loss that was quite unmanageable into a more manageable loss officially of that $800. Okay, so the moral of the story is simply this: when you are in a situation where you have short puts, and again, this works just as well on the call side, and I showed you the 4 different things you can do, think of the 5th option, right? Think of that as door number 5, where you could spend a little bit more money, put something in front of that short put. Obviously, you are putting yourself in a situation where you are putting out more debit. You may be adding insult to injury, but if you have a good grasp of technicals and you feel like, you know what, I really think this market is going there, and you don't want to play the hope card, then instead of buying it back, rolling it, pushing it lower, putting something underneath it, why not buy something above it? And then when that move happens that would have scared the crap out of you, right? And you would have been sitting there defending a naked option or watching your account blow up, instead, you're making money. The The chart to watch this week is something you should all be familiar with, not only from the past, because I have talked about it on this program a few weeks ago, but I want you to pay attention to this chart going forward, and it is the TNX, once again, the chart of the 10-year yield, because it is moving up sharply, and whatever weakness that you saw in the markets today on Friday, January 10th, a lot of it was due to how this happened. If you go back and look at the TNX, right on the 8:30 mark, 8:30 Eastern of Friday, January 10th, that's when the employment data was released this morning. Payrolls came in hot. Unemployment rate ticked back down to 4.1%. It's been kind of holding at that level. We never got the move up past that we were expecting, and there was a huge surge in 10-year yields right at that point. I just purposely wanted to mark off where some of these key tops are going forward. You can see the swing high here is just under 5%, which happened around mid-October to November, later in 2024, 4.997%. This swing high here is noteworthy in that it was 4.737%, a little bit past that, but look what happened today. We hit a high of 4.79, so we're not far from that 5 handle. I've read a few things online saying that people are expecting there could be as high as 5.5 before the end of the year. We shall see. That's a ways to go, but this is definitely, in the bigger picture, not moving in the right direction for folks who are long-term holders of equities. Eventually, the market will not like it. It didn't like it so much today, but as I was saying, it seems like the market is moving down, still in a more sort of rotational manner. Not that much rotation today, but still a little bit, not all-out bearishness, but this is definitely the chart to watch going forward. Again, it is the 10-year yield on bonds, and it is getting very, very dangerously close to that key 5% level. I'm going to be watching very, very closely, obviously, to see if that level is tested going forward, but also what yields do when they hit that level. Do we see some backing off, or do we push through? If we do get some sort of push through, I think that's going to be a little bit of shock and awe for equities, and you may see some stronger selling, and that may be the catalyst for the acceleration that I talked about earlier, vis-a-vis that wagon wheel running fastest at the bottom of the hill and causing some sort of a spike lower in stocks. Time now for our number one draft pick. This is, of course, where I give you just one idea that I'm kind of excited about moving forward. And this week's idea is on Netflix, with the caveat that it is not something that I believe is in play right now. It's something that I'd like you to be watching for the future. And I'm going to give you a couple of key levels where I think it could be in play. This is one of the strongest stocks on the board right now. Fundamentally, things are going really well for them. They are going to report earnings on the 21st. We'll see what kind of quarter they have. But from a technical basis, there are some areas that you should be looking to pick up shares of Netflix, I think, in the future. So let's head over to this chart here. I've taken a snapshot here. It's not the usual chart that I show you, not from the trading platform. This is actually from TradingView. And the reason I did so is simply for the fact that this gives me the ability to put the anchored VWAPs on from whatever level I want, which I really like. And you can see here, I've put one here from this gap here. And that is actually where we are right now. We actually moved through it a little bit. You can see the big candle moving lower, but focus, if you can, going forward on the trend lines in Netflix, because this is where I think there's going to be some opportunity going forward in this stock, okay? You've got a trend line from this low here, touching here. That's bringing prices into just about the 780 area. And look at the purple line here. That's anchored VWAP going back to where? Right here, starting at that swing low, which is important. You want to anchor your VWAPs always at swing highs, swing lows, key areas that are actual turning points in the market, and this certainly has that. So I find that interesting that that anchored VWAP is tying in right with that. If we get lower than that, then you've got a dominant sort of primary trend line here, and that's going to be in the 740 area, and you can see I've circled that level as well. Where is it going to stop? I don't know. Remember, if this is more of a longer term play for you, you want to be maybe buying in tranches as we move down. But these are the levels that I'm going to be looking at. Of course, for my own personal trading, I'm always trying to time everything with the activity in the broad market. So I would prefer to see some sort of that acceleration that I was talking about earlier in terms of a flush washing out buyers at the worst possible time and seeing if strong stocks like this have some sort of spikes lower towards those key levels of the trend lines or anchored VWAPs. Another thing you want to be watching for, of course, is relative strength. Is if we get that type of a move lower, what if the flush move in Netflix is not as big, right? If it sort of just holds its own at some point in this area while the market moves lower. These are all the types of technical signals that I would be looking for a potential long setup in Netflix. As we started doing so recently in the last just couple of shows, I added this segment here looking ahead that I like because it is very important for us to take note of what key economic data or earnings reports are coming next week, and next week is going to be hot and heavy, so you need to be remembering these things. Let's take a look at the calendar here for next week. We've got nothing of note on Monday. Remember, if the economic data is of low impact, I don't discuss it. I only discuss economic data that is of high impact. So we've got PPI coming out, Producer Price Index, on Tuesday. Wednesday is going to be CPI and core CPI. These are pretty important. Remember that these are measures of inflation that the Fed is looking at, so it's important. On top of that, bank earnings. Look at all these financials all happening on the same day. Citigroup, JP Morgan, Goldman Sachs, and Wells, that's going to be Wednesday. And then on Thursday, the financial party continues with Bank of America and Morgan Stanley. And that's also coming together with retail sales, initial claims, and continuing claims. So this Thursday could actually be quite volatile next week, given that you've got high impact economic data and the tail end of these financial earnings is happening as well. And then out to Friday, it's going to be housing starts and building permits. So overall, it's stacking up to be a potentially relatively volatile week. Remember, a lot of this stuff as far as the economic data, that's usually released at 8:30 a.m. Eastern time, and a lot of time that's what causes the larger gaps in the market that you see. That's where bigger moves are happening overnight, but obviously these earnings as well, some of these are going to be reporting before market. A lot of these financial firms usually don't do the sort of post-market thing that tech earnings do. They'll go before. So that also could add to some of the volatility. So be watching all of this stuff closely next week because it could be a little bit of a more volatile week. And that's my show for this week. Thank you, as always, for spending a little bit of your weekend with me. Hit those like and subscribe buttons if you can, and also the bell to be notified when ShadowTrader posts new videos, which, remember, is nightly. That's the Shadow Shorts of myself and my team, giving you trade ideas 5 days a week in a short form, I should say, content of, say, 2 minutes to 5 minutes, just kind of detailing trade ideas or something really, really important that's happening in the markets at that point. All right. What's going on in the markets right now and what do we need to be thinking about for next week? I think we are moving down for now in kind of a choppy manner, but as I was saying, what's the danger? The danger is, of course, of that wagon wheel running fastest at the bottom of the hill. I've seen this movie before, and this often happens, in that the market lulls you into a false sense of security in that, yes, it's coming down, but it's like one day down, one day back up, etc. But then you get some acceleration. So we'll see if that occurs. And as we were discussing earlier, potential is there for a spike in yields to be that catalyst to accelerate that, right? Remember, most people in the markets will do the wrong thing at the wrong time. So this is why when that selling intensifies sometimes and it's bigger than expected or bigger than it was prior, it may actually be the end of the move. It's not the start of the move because people are just doing the wrong thing at the wrong time and kind of throwing all those sell orders at the market when they shouldn't be. So be watching that 10-year yield closely next week, and also a lot of those financial earnings that we talked about. That, I think, that put together with that economic data, I think that's going to be key next week. All right? Be safe out there. I'll see you next week. As always, I wish you good trading and good night.